Welcome to the deep dive. Today we are taking the glossy, highly produced world of reality television and subjecting it to the ruthless scrutiny of a real estate spreadsheet.
Yeah, pulling back the curtain, basically.
Exactly. We are tearing down the shiplap and the exposed brick of the house flipping fantasy to expose the high stakes, high discipline machine required for genuine success in real estate turnover.
That's right. The allure is powerful, isn't it?
Yeah.
Buy low, renovate quickly, sell high. But that quick profit, if it even happens, it's merely the end result of immense hidden labor.
So what's our mission today?
Our mission today is really to give you a shortcut, a way to get well informed on the necessary ingredients. We're talking the foundational psychological discipline,
Okay.
the rock-solid systems you absolutely need, especially for remote management, and that granular financial literacy required to navigate acquisition, aggressive value creation, and, crucially, managing the inherent risks in this high-stakes game.
Because what the TV shows meticulously edit out is that fundamental distinction. Successful, sustainable real estate ventures are absolutely not about getting rich quick.
No, definitely not.
That pursuit usually ends up being more like a speculative lottery ticket, where timing and luck are just everything. The path to lasting wealth in this business, as our sources emphasize, it requires creative leverage, acute systemic organization, and above all, patience.
Exactly.
Mm.
We are talking about building a financial machine, you see, not just grabbing a single cash payment. While the speed of growth is certainly influenced by that volatile triad of luck, location, and market timing.
Especially interest rate shifts, right? We see that now.
Oh, absolutely. Those shifts are critical.
Right.
But the foundation of lasting wealth is laid through deliberate strategy and a fundamental re-engineering of your financial outlook.
Mm-hmm.
True wealth accumulation, it takes years of compound effort.
So if the payoff is an instant, where does the journey actually begin? It seems like it starts internally.
It really does. It starts with the internal circuitry, that psychological shift required to move from the, let's say, impulsive mentality of a consumer to the methodical discipline of an investor. This is the psychological shift that, frankly, most aspiring flippers fail to make.
So it's about being versus getting.
It is the difference between focusing on what you get versus focusing on who you are. Our sources really emphasize the power of identity-based habits over purely outcome-based habits.
Okay, explain that a bit more. Identity-based habits.
Well, if you focus purely on the outcome, that big check after the sale,
Hmm.
it's fleeting. What happens if the market drops and the check is small or worse, negative? You quit, right?
Right. Discouragement sets in fast.
Exactly. Lasting success is driven by the internal question, who do I wish to become? I am an investor. That identity, that core belief system, it dictates consistent behavior regardless of the temporary market turbulence. It's about the long game.
I think that identity-based approach really addresses why so many people stall out after maybe one or two attempts. We're talking about a business that demands extreme persistence and a clear definiteness of purpose.
Precisely. You hear it often, right?
Mm.
Most people cannot actually define what they want most in life. If you ask them what success looks like, they give these vague answers about more money or less stress.
Sure, very general.
Yeah. If you can't define what you want, if you can put a specific number on the number of units you aim to own, or the cash flow you actually need, or maybe the market you plan to dominate, you certainly can't build a profitable system around it, especially not in real estate, which demands intense local knowledge and specialization.
And that lack of purpose, I imagine, relates directly to how capital is handled, which seems like the immediate failure point for many who maybe do make a sudden profit.
Oh, it is the moment of truth.
Yeah.
Absolutely. Successful investors, they willingly make calculated short-term sacrifices for long-term exponential gains. They prioritize capital over consumption.
Okay, capital over consumption. What does that look like practically?
Well, the mindset of a consumer sees an extra, say, $10,000 from a successful flip and immediately thinks, great, new car, vacation, satisfying immediate wants. That's lifestyle creep.
We've all seen it.
We have. The investor, conversely, ensures that every spare dollar, every single unit of cash flow, is immediately reinvested to accelerate the wealth-building process. They are relentlessly feeding the financial machine they build, ensuring it grows exponentially rather than just plateauing after one win.
Okay, let's unpack the shift further by defining the actual strategy. When we talk about flipping, we are talking about cash versus wealth, and they sound similar, but they are distinctly different goals with different financial outcomes.
Very different. Real estate acquisition fundamentally splits into two major strategies based on your intent. You can buy for cash, which, encapsulates quick turn strategies like wholesaling or flipping for immediate liquidity and profit. This focuses on optimizing that immediate cash-on-cash return.
Get in, get out, get paid.
Pretty much. Or you can buy for cash flow and equity buildup. This is the long-term buy and hold strategy using rental income and maybe the BRRR model we'll talk about. It's about wealth accumulation over time.
The quick cash flip gets all the fanfare, all the TV shows, but the wealth-building long-term approach, that seems to be the one that truly builds generational stability and, importantly, minimizes tax exposure.
It absolutely does. Millionaire investors, they view selling outright as the final last resort. Why? Because a direct sale triggers significant capital gains tax liabilities on the net profit. They're constantly looking for ways to keep that capital working for them.
So what do they do instead of selling?
Well, they prefer options that maintain liquidity while minimizing taxes. Things like refinancing to pull tax-free equity out of the property or performing a tax-deferred 1031 exchange.
Okay, let's elaborate on the 1031 exchange. That's one of those major tax advantages people hear about but might not fully grasp, especially if they want to build wealth efficiently.
It is incredibly powerful. Essentially, it allows you to swap one investment property for another, like-kind property, without triggering a taxable event on the profit you made, provided certain strict rules are followed.
And those rules are strict, right? What are the key deadlines?
Oh, they are non-negotiable. Once you close the sale of your original investment property, the clock starts ticking. You only have 45 calendar days, not business days, to formally identify up to 3 potential replacement properties in writing.
Just 45 days to find and identify. That's tight.
It is. And then you have 180 days total from the original sale closing date to successfully close on one of those identified properties. Not just get it under contract, but actually close. Missing those precise deadlines makes the entire profit immediately taxable that year. The discipline required for that 45-day sprint, it's intense. You need your ducks in a row before you even sell the first property.
Okay, so now we transition from the mindset, the why, to the mechanism. How do you actually acquire these properties, especially when you might not have, hundreds of thousands of dollars saved up? This is where that magic word comes in, leverage.
Leverage. It's the art and science of the business, really.
Yeah.
When we hear the term investing with no money down, it's often a bit of a distortion, isn't it?
Yeah, sounds too good to be true, usually.
Real estate is never free. It always requires capital. The true meaning is using other people's money, OPM, to acquire the property. Whether that money comes from banks, private lenders, hard money lenders, or even government programs, it's about shifting the source of the necessary cash from your own savings account to a debt instrument, thereby amplifying your potential returns.
And surprisingly, the government actually helps build wealth relatively quickly here, especially for first-time investors who are willing to live in the property for a bit.
That's where the power of owner-occupied leverage really shines. A first-time investor can buy a small, multifamily property, a duplex, triplex, or maybe a fourplex, live in one unit as their primary residence, and then rent out the other units.
And the benefit there is the loan type.
Exactly. Crucially, because that loan was intended for their primary residence, they benefit from high loan-to-value LTV financing, often 90%, 95%, even sometimes higher, requiring minimal cash down compared to a pure investment property loan.
Which usually requires, what, 20-25% down?
At least. So after fulfilling the typical one-year occupancy rule, they can move out, put a tenant in their former unit, and potentially repeat the process on a new primary residence. You can see how someone could rapidly accumulate several rental properties this way without needing massive down payments each time.
Okay, so what's the most accessible tool for that initial leap? The one that minimizes the barrier to entry for someone with good credit, but maybe not a huge pile of cash?
The FHA loan is often the go-to example. It's ideal for first-time real estate investors, or really anyone with decent credit and job stability, but minimal cash reserves. While it's not truly no money down, it requires only a 3.5% down payment plus your closing costs.
3.5%, that's much more achievable for many people.
It's a highly realistic starting point.
Yeah.
But, the investor must be prepared for the added cost of mortgage insurance premium, or MIP, that comes with a low down payment on an FHA loan. That adds to your monthly payment.
Right. There's always a trade-off. That brings us directly to the famed BRRR, model buy, rehab, rent, refinance, repeat. It sounds like the pinnacle of the forced appreciation strategy, and it seems to rely entirely on smart refinancing based on ARV or after repair value.
Absolutely. The BRRR model can be very cost-effective because of the timing and the basis of that final financing step, the refinance. You see, a traditional lender giving you a purchase loan determines the loan amount based on the often low pre-rehab purchase price or the current value, whichever is less. In BRRR, you typically use short-term, often higher interest financing like hard money or private money for the acquisition and the renovation. But the final long-term loan, the refinance, is based on the after-repair value of the fixed-up, stabilized, and hopefully rented property. The bank is now valuing a better, more valuable asset.
Ah, so because the property's worth more after the rehab, the bank is willing to lend more on it during the refinance step.
Precisely. This allows you to potentially pull out more cash, sometimes even all of your initial investment, plus the rehab costs, tax-free, which you then use for the next deal. That's the repeat part.
But isn't that exceptionally risky, using high-interest debt up front? I mean, what happens if the renovation goes 6 weeks over schedule, or maybe the ARV appraisal comes in lower than you expected?
That's the critical high-stakes risk that television often ignores completely. If you overestimate your ARV, you face an appraisal gap. The bank won't lend you enough during the refinance to cover the initial hard money loan and all your renovation costs. This forces you to bring additional cash to the closing table, which can seriously erode or even wipe out your profit margin.
Ouch.
Even worse, if the project gets delayed or the property fails to rent quickly once it's done, you are left carrying that expensive hard money loan, often paying 10%, 12%, even 15% interest longer than you planned. Those carrying costs, things like interest, taxes, insurance, utilities, they can easily eat up thousands, maybe $5,000 to $10,000 a month on some projects just in interest. That can wipe out your anticipated profit in just a couple of months of delays.
So the successful execution of BRRR hinges entirely, it sounds like, on a robust exit plan for that expensive short-term debt. You have to know how you're getting out of it before you get into it.
Absolutely. Hard money loans are tools for speed and leverage, not for holding long-term. They are short-term instruments, often with terms of 6 to 12 months, maybe 18 at the outside. The crucial step is to immediately plan and execute the refinance, swapping that hard money loan out for a new, low-interest long-term loan from a conventional bank as soon as the property is stabilized, meaning fixed up and rented, generating income.
And you mentioned pulling cash out.
Right. This also introduces a secondary point. Experienced investors almost always prefer a cash-out refinance over a simple rate-and-term refinance when doing BRRR, specifically because that cash-out option allows them to pull out that newly created equity, tax-free, which they then deploy into the next BRRR property, enabling the repeat stage and keeping the velocity going.
Okay, so we've covered the money sources, the leverage, but none of it matters if you can't find a deal in the first place. This is where the relentless work really begins. I've heard it said that a great deal is the foundation of this entire business.
It is absolutely the most foundational and, frankly, arguably the most difficult part of any quick-turn strategy, like flipping or wholesaling. Great deals, the ones with real profit potential, are rarely just sitting there listed on the MLS waiting for you.
So where do you find them?
They require proactive effort. Direct marketing to potential sellers, networking with wholesalers, attorneys, contractors, driving for dollars looking for distressed properties, consistent effort to find motivated sellers who need to sell quickly or have a property that needs significant work.
And the core principle is always looking for problems to solve.
Exactly. The core investment principle here is simple yet critical. Buy only property that needs improvement. That necessity for rehab is where you create forced appreciation. You make your own value through sweat equity and strategic spending, rather than just passively waiting years for general market appreciation, which you can't control.
Finding the deal is one thing. Closing it, especially when the seller might have, let's say, unrealistic expectations about price, that's another challenge. When you're negotiating, what are the subtle psychological levers that can shift the outcome in your favor without blowing up the deal?
That's a great question. Sellers generally prefer clean, no-strings-attached offers. An offer that's straightforward, maybe it's cash or has strong financing pre-approval, quick closing timeline, minimal contingencies, that might win out even if the price is slightly lower than a more complicated offer with lots of inspection demands or financing uncertainties.
Simplicity is valuable to them.
It is, but the sophisticated approach requires avoiding a massive pitfall. You must avoid pushing so hard on price or terms that you create genuine resentment in the seller.
Why is resentment so dangerous in this context? You got the deal signed, right?
Because the closing process itself is often complicated. Deals rarely go perfectly smoothly from contract to close. If the deal stumbles, maybe a title issue arises unexpectedly, or the buyer's lender hits a delay, A resentful seller won't lift a finger to help you fix the issue. They might even actively obstruct it, feeling somehow entitled to see the deal fail after feeling pushed around.
Wow. Okay. Can you give an example?
Yeah, we saw one flipper lose about $15,000 in earnest money because he hammered the seller relentlessly on the price, really rubbed them the wrong way. Then, a minor easement issue cropped up just 2 days before closing something easily fixable with a quick signature. The seller, still feeling resentful, simply refused to sign the corrective deed needed to clear the title issue. They just dug their heels in, forcing the flipper to terminate the contract and forfeit the deposit because they couldn't close on time.
That's a powerful and expensive lesson. So how do expert negotiators approach finding a solution without creating that hostility, especially when a seller is anchoring to an unrealistic price?
They often use calibrated how questions. These are open-ended questions designed to gently guide the seller towards seeing the problem from your perspective and ideally participating in finding your solution.
Okay, like what? Give me an example.
All right, let's say the seller demands $300,000, but the property clearly needs $50,000 in essential repairs. New roof, old HVAC, maybe foundation issues, and comparable fixed-up homes are selling for $350,000.
Hmm.
So for you as a flipper needing profit margin, it's only worth maybe $250,000 as is. You don't just say, "That's crazy, I'll only pay $250,000. That creates confrontation.
Right.
Instead, after presenting your well-supported $250,000 offer and having them reject it, you might calmly and respectfully ask something like, "Okay, I understand you're looking for $300,000. Can you help me understand how I can possibly get you to that number when, based on the inspection and contractor quotes, the roof, the HVAC, and the basement water issue all require immediate replacement? That's going to cost me over $50,000 before I even touch any of the cosmetic updates needed to get it market ready."
Ah, so by using how, you are effectively forcing them to mentally walk through the problem from your side to search for a way to bridge that gap. It might involve them having to justify your lower offer to themselves or finally accept the reality of the repair costs. That's clever.
It shifts the dynamic from adversarial to collaborative problem solving, hopefully.
Mm-hmm.
It respects their position while clearly outlining your constraints.
All right, so the deal is locked, the negotiation is done. Now the operational phase begins, creating the actual value. We transition from psychology and finance to more like engineering and project management. What is the guiding principle for the renovation itself? How do you decide what to fix?
The cardinal rule of improvement is pretty simple but crucial. Make only selective improvements that dramatically increase the property's value relative to their cost. You're not building your dream home, you're building what the market wants and will pay for.
So avoid over-improving for the neighborhood.
Absolutely. And always be pursuing the highest and best use of the property within zoning and market constraints. For example, if you're working on a massive old 3-bedroom home, but the local market strongly demands 4 bedrooms for families, perhaps the highest and best use involves cleverly splitting a huge master bedroom or converting a formal dining room to create that functional 4th bedroom.
Or maybe adding a unit.
Exactly. If zoning permits and market demand supports it, converting that large single-family home into a duplex or even a triplex could command significantly higher total rental income or resale value, truly maximizing that property's potential use and return.
Flipping requires optimizing the property for the next buyer, which means you absolutely have to address those big, scary structural issues that scare away the typical middle market purchaser.
Oh, absolutely. The importance of fixing to sell cannot be overstated, especially when you're targeting first-time or move-up buyers, not just other investors. Properties in poor condition, they deter both ends of the market.
How so?
Well, first-time buyers are often intimidated by the potential expense and sheer labor involved in major repairs. They want move-in ready and experienced homeowners. They know exactly how time-consuming and costly things like foundation work or a new roof really are, and they don't want to go through it again.
So what if you find a major issue, like a foundation crack, but maybe fixing it blows your budget? Can you just disclose it and sell as?
You must disclose known material defects, legally and ethically. But just disclosing a scary problem isn't enough if you want top dollar. If you genuinely cannot afford a critical repair, the best approach is to hire a reputable expert, say, a structural engineer for the foundation, get a detailed report, and a firm, professional, ideally transferable repair estimate, or quote. Then you disclose the problem along with the professional solution and cost. This helps mitigate buyer fear and potential liability down the road. Skipping major structural fixes is just a recipe for disaster, potentially leading to lawsuits long after the sale.
Okay, that makes sense. And what about the low-hanging fruit? The exterior details that create that critical first impression, the curb appeal, how important is that really?
Curb appeal is huge. It starts before the buyer even gets to the property line. The exterior must project a sense of care, ease of maintenance, and quality workmanship. Specific details are key.
Like what? Beyond mowing the lawn?
Definitely mow the lawn. But also, if you have sidewalks, they must be perfectly clear, no leaves, litter, weeds, overgrown branches. Keep shrubs trimmed neatly away from the house, fresh mulch and flower beds. Maybe paint the front door a welcoming color.
Huh?
And here's a common, maybe surprising detail, especially in colder climates.
Go on.
Remove all visible icicles from the roof edge or gutters in winter. It seems minor, but icicles instantly signal potential problems to an informed buyer, things like poor attic insulation, inadequate ventilation, or ice damming issues, all of which can lead to roof leaks and water damage inside. It's a massive, immediate red flag that suggests expensive deferred maintenance might be lurking.
Wow, I wouldn't have thought of icicles specifically, but it makes sense as a visual cue of neglect or hidden problems. That level of detail brings us to the actual costs. How do professional flippers approach renovation cost estimation? It seems like costs would be highly specific to location, but is there a universal methodology that helps reduce those catastrophic budget overruns we hear about?
There is. While the actual dollar amounts are highly variable based on your geography, the cost of labor, your contractor relationships, the methodology must be systematic and based on hard data, not guesswork. You must always budget a contingency fund, typically 10% to 15% of the total estimated rehab cost for the inevitable unexpected issues that will pop up.
The uh-oh.
Exactly. And a core rule for material accuracy, especially for flooring, is the waste factor. You must budget for about 10% more material for flooring jobs like carpet, tile, or laminate than the strict square footage requires. This accounts for cuts, angles, mismeasures, and installation waste. Failing to order that extra 10% up front means you risk being mid-job, waiting 3 days for just 3 more boxes of tile to arrive, costing you valuable time and possibly extra labor charges from your contractor who's stuck waiting.
Good practical tip. Can you give us some specific practical examples of those baseline costs investors should be aware of, especially for those common cosmetic fixes that drive appeal, like paint?
Certainly. Take painting, which generally offers the greatest cosmetic return on investment. Sometimes investors think about saving money by painting just the trim, leaving the walls as is if they're okay. But painting trim only often costs roughly 40 cents to maybe $1.80 per square foot of interior floor space.
Why so high per square foot if it's just trim?
Because trim work is detailed and labor-intensive. It requires careful brushwork, extensive prep like sanding and caulking, and lots of taping to protect walls and floors. It's slow work. Often, professional flippers realize that for only a slightly increased total cost, maybe moving up to $1 to $1.50 per square foot, they can just paint the entire house interior, walls and trim included. This gives the maximum fresh, clean aesthetic impact for what might be a minimal difference in the overall budget, because spraying walls is much faster than brushing trim.
That makes perfect sense. The labor efficiency changes dramatically. What about other common items like flooring and those small contractor jobs that seem to pop up constantly during a rehab?
Yeah, for flooring, know your labor benchmarks. The labor for installing basic carpet and pad averages around $3 to $5 per square yard. Installing laminate wood flooring labor is often a bit cheaper, maybe ranging from $1 to $3 per square foot. These are just labor costs, of course. The material cost is separate and varies wildly. In terms of plumbing, smaller jobs should be quickly quantifiable so you don't get overcharged. For example, just hooking up the drain line and the hot-cold supply lines to a new bathroom sink or vanity top, assuming the pipes are already roughed in nearby. That should cost a plumber maybe $30 to $50 in labor if they're already on site doing bigger work. If you're calling them out just for that tiny job, expect to pay their minimum service fee, which could be $150 or more. Knowing these kinds of benchmarks allows you to quickly assess quotes and challenge contractors who might be padding bills for minor tasks.
Right, it prevents you from getting nickel and dime to death. Ultimately, the ability to flip multiple houses efficiently or maybe manage projects long distance, it seems like it requires eliminating chaotic, reactive decision-making. That necessitates systematizing the rehab.
Yes. Systems are what eliminate decision fatigue and ensure both time and cash efficiency. If your rehab crew knows your standard material palette, the specific paint colors you always use, the model of light fixtures you prefer, your go-to LVP flooring choice, and your exact execution sequence for tasks, they can complete projects faster, more consistently, and usually for less money because there's less confusion and fewer trips to the store.
And for long-distance projects, that seems even more critical.
Especially true for long distance. The recommendation there is often to start small by building a trustworthy core boots-on-the-ground team first. Hire a really reliable, detail-oriented housekeeper you trust implicitly, and find a similarly reliable and skilled handy person. These two individuals are often highly connected locally and can then recommend other reliable, vetted, specialized vendors like plumbers or electricians they've worked with before. This helps you bypass the incredibly difficult and dangerous process of trying to vet unknown contractors remotely just based on phone calls or online reviews. Build the core team first.
Okay, the renovation is finally done, the house looks great on paper, and now it has to sell quickly to minimize those carrying costs we talked about. This transition moves from construction science to marketing art. It sounds like it's all about staging for the target market.
Absolutely. At this point, you are no longer just selling a house with X beds and Y baths. You are selling a lifestyle, a vision, tailored specifically to the demographic most likely to afford and want that particular property in that specific location. The property has to be branded, in a sense, for its most likely group of buyers.
Branded. How so?
Every single choice made in preparing the home for sale, from the wall color right down to the scent of the air freshener and the placement of decorative accents, must appeal directly to the known generational preferences and aesthetic needs of that target buyer.
That's fascinating. How does generational preference play into design details beyond just, modern versus traditional? Can you give an example?
Yeah, we see clear examples from staging experts. If you were targeting an older, more established buyer, say a baby boomer, they often respond well to classic aesthetics. Things like Chinese export ceramics, traditional brass lamps, and maybe richer, more layered colors. They're often skeptical of shiny chrome fixtures, sometimes viewing them as looking cheap or feeling cold.
Okay. And younger buyers?
Conversely, if you are targeting younger millennial or Gen Z buyers, they often prioritize things differently. Maybe seamless smart home integration is appealing, definitely open concept kitchens, great for entertaining, and often minimalist or highly functional storage solutions like sleek built-ins or stylish open shelving. The staging needs to reflect that functional preference and tech savviness.
And beyond generational styles, there are basic design rules too.
Oh yes, design details matter immensely for creating flow and harmony. For instance, a rug should always visually embrace the furniture grouping it sits with. It should mirror the furniture shape, like a rectangular rug centered under a rectangular dining table, or a large circular rug anchoring a circular seating arrangement in a living room. This creates visual coherence and makes the space feel intentional. Avoid tiny postage stamp rugs floating alone in the middle of the room.
Good tip. And there's one aesthetic choice that seems to be the universal enemy of good staging, according to the pros.
Is the television. The advice is almost always, remove TVs wherever possible for showings and photos. They are just visual clutter. When they're turned off, they're just big black reflective holes on the wall, immediately distracting the buyer's eye from the features of the room.
And if it's an older TV?
Even worse. More importantly, if a TV is present, and it is not a modern, sleek, flat screen mounted nicely, it instantly suggests that the entire home might be dated, potentially undermining the massive investment you just made in the rehab. You are trying to sell a vision of the future, their future in this house, not a reflection of the past decade's technology.
But staging is about more than just aesthetics, right? It's selling the feeling of possibility. You mentioned selling space and flow, the emotional space for the buyer's life.
That's the crucial psychological sale happening. You absolutely must create the impression of abundant, effortless storage. The most effective classic trick in the staging book is to clear out all closets and cabinets, then put back only about half the items neatly organized.
Leaving them half full.
It suggests to the buyer, subconsciously, that they will easily fit all their own possessions into these spaces and still have room to spare. You are physically and emotionally decluttering the space, removing any sense of the previous owner, allowing the next owner to mentally project their own possessions and life onto the blank canvas you've created. Space is often what people are buying.
Interior design can even be used almost like an optical illusion, can't it? To manipulate how a room feels, which could be crucial if a room is awkwardly sized or shaped.
Absolutely. You can use lines, color palettes, and even patterns strategically to change the perception of a space. For instance, if you have a very large, modern, open-plan great room that might feel a bit overwhelming, cold, or undefined, you can use the darker color palette on one wall, perhaps a rich accent wall, or maybe use pattern wallpaper in a specific zone like the dining area. This can strategically shrink the perceived space visually, making it feel cozier, more intimate, and intentionally designed.
And for small spaces.
Conversely, If a hallway feels too long and narrow, using flooring with horizontal lines can make it feel wider. If ceilings feel low, using vertical stripes in paint or wallpaper can draw the eye upward, making them feel taller. It's about understanding visual tricks to enhance the perceived dimensions.
Okay, finally, the sale itself. It requires intense sales execution. You can have the best staged house, perfectly renovated, but if the execution on the sales side fails, the flip stalls and those carrying costs start piling up again.
You got it. Sales, as one source put it, is often described as a race, but nobody tells you how long the track is. Success is really built on relentless work and sheer endurance. The more targeted ads you run, the more open houses or showings you conduct, the more connections you make with buyer agents, the more you ultimately sell. It's about putting in the consistent, defined work, not just listing it and waiting passively for the market to come to you.
And the high-level discipline that seems to separate the truly successful sales agent or flipper selling their own property from the average one isn't just basic follow-up. It's described as follow-through. What's the difference?
Follow-through is the bedrock of dependability and professionalism. It means doing exactly what you say you are going to do, precisely when you said you would do it, answering emails within an hour or two, not 2 days, getting back to a client with the requested research or documentation by the end of the day as promised. This builds trust, demonstrates reliability, and shows clients and other agents that you are professionally invested in their outcome and respect their time. It seems simple, but it's surprisingly rare.
Trust is especially important today, perhaps, where technology handles so much of the transaction process. What advantage does a human salesperson still hold over just finding a house on the internet?
Empathy. Genuine human empathy and emotional intelligence. That's the edge. You must listen deeply to the client, whether it's the buyer or their agent, understand their underlying fears, their pressures, their specific timeline needs, and then respond thoughtfully and appropriately, rather than just firing back a standard pre-written template reply.
So connecting on a human level.
Exactly. The best salespeople, or flippers managing their sale, put themselves in the client's shoes. They acknowledge that the process of buying or selling a home is inherently stressful and often overwhelming for people, and they offer tangible support, patience, and understanding throughout that process. That human connection can make all the difference.
Okay, we've covered mindset, money, systems, staging, and execution. It feels like we've built the perfect flipping machine, but even the most disciplined flipper operates within a larger, volatile system that's completely outside their direct control. We absolutely must address the reality of market volatility.
This is where the sober reality of high-stakes real estate really hits hardest, isn't it? A flipper, by definition, is relying on the market holding steady or, ideally, appreciating slightly during their relatively short 6 to 12-month turnover period.
But history shows that's not guaranteed.
Not at all. History shows us this is absolutely not guaranteed. Consider the New York City market case study back in the mid-2000s. You had these massive apartment complexes like Stuyvesant Town Peter Cooper Village bought near the peak for billions. Their estimated values plummeted incredibly from around $6.3 billion down to maybe $1.9 billion in just 2 years, following the 2008 Wall Street collapse and the ensuing recession.
Wow. Billions. Loss.
Billions. Now, that's a huge scale, but it illustrates that even in established, historically strong markets, property values can drop sharply and suddenly due to broader economic conditions. A flipper who bought near a market peak, intending a quick profit, could suddenly face selling at a massive loss or being unable to refinance out of their expensive short-term loan.
That scary scenario means we can't afford to be just philosophical about risk. We need concrete tactics. Flippers have to continuously engage in critical thinking and avoiding groupthink, right? Not just follow the herd.
They absolutely must. Investors need to deeply understand their own financial limits and their personal risk tolerance. Can you actually afford, realistically, to carry 2 hard money loans for an extra 3 or 4 months if the market suddenly freezes and nothing sells? What's your plan B, C, and D?
And you can't just look at past performance.
Furthermore, you cannot rely solely on recent historical returns to predict the immediate future. As the stock market demonstrated back in the late 1960s and through much of the 1970s, fundamental changes in market structure, inflation, interest rates, and perceived risk can generate decade-long periods of flat or even poor returns, even if the very long-term fundamentals look sound on paper.
So the lesson for flippers.
The lesson for flippers is stress test your numbers relentlessly. Assume things will go wrong. Assume your ARV might come in 10% lower. Assume your holding time will be 3 months longer. Assume your repair budget will be 15% higher. Can the deal still work under those stress conditions? If not, it might be too thin.
What are some concrete, actionable risk management tactics that successful, experienced flippers employ beyond just budgeting that small contingency fund?
There are several key ones. First, many sophisticated flippers secure gap funding before they even start. This could be a prearranged line of credit or a standby agreement with a private lender that can kick in to cover payments if the hard money loan expires, before the permanent refinancing closes, or before the property sells. It buys them breathing room.
Okay, that makes sense. What else?
Second, they never skip title insurance. Ever. This protects the investor from unforeseen clouds on the title, things like old lay-ins, boundary disputes, undiscovered heirs, or previous ownership claims that could completely derail the sale or refinance and cost a fortune in legal fees to resolve. Title insurance is non-negotiable.
An environmental issue.
Yeah, that's the third big one. Rigorous environmental due diligence is essential, especially on older properties. This means checking for potential hazards like mold, especially hidden mold, asbestos-containing materials, lead-based paint, underground oil tanks, all of which carry significant remediation costs and legal liability. These issues must be identified, properly disclosed, and often professionally mitigated before sale, as the liability typically follows the property owner.
So, with all these potential pitfalls and market shifts, how does the investor guard against making chaotic, impulsive decisions when a project inevitably goes sideways or the market takes an unexpected turn?
They rely heavily on the value of systems and accountability. The single biggest trap for many entrepreneurs, not just in real estate, is chaotically focusing on the trivial many, the urgent but ultimately low-value activities like constantly checking email or social media, or running to Home Depot 3 times a day for a single forgotten item. That feels busy, but it's not productive.
So, focus on what matters most.
To achieve real breakthrough results, you must systematically practice the vital few activities that actually generate the most results in flipping. Typically, these are things like consistent deal analysis, proactive lead generation for finding new opportunities, and disciplined capital management and fundraising. Everything else should be systemized or delegated if possible.
Okay, let's unpack that systematic discipline a bit more. How do you actually ensure execution on those vital few activities when the day-to-day chaos of construction or deal-making hits? It's easy to get distracted.
It requires learning consciously to execute the plan regardless of how you feel in the moment, stepping away from the emotional roller coaster of construction delays or sales negotiations. The core mechanism many successful investors use for this is the weekly plan.
Which is more than just a to-do list.
Oh, much more. It's not just a glorified to-do list of tasks. It's a strategic instrument that organizes and forces focus on your most important activities for the week ahead. It translates your bigger, maybe 12-week strategic goals, like, say, getting 3 new properties under contract this quarter, into specific, scheduled, daily action items.
Example.
Like blocking out 2 hours specifically for proactive lead generation calls on Tuesday morning, scheduling mandatory contractor check-ins every Friday morning to catch problems early, allocating time every Monday afternoon for reviewing financials and capital needs. It forces conscious execution of the important, non-urgent tasks in the moment, which is where true progress and wealth are actually created, not in reactive firefighting.
Before we wrap up, we need to return briefly to the concept of wealth generation. We mentioned earlier that the ultra-wealthy often try to avoid selling assets like real estate because of taxes. What specific tax advantage does holding rental real estate offer over, say, just investing in the stock market?
This is one of the hidden, or maybe not so hidden, advantages that makes real estate such a powerful wealth-building vehicle over the long term. It is depreciation write-offs.
Explain depreciation.
Okay, so the IRS allows owners of investment properties, including rentals, to deduct a portion of the structure's cost, not the land, each year over a set period, typically 27.5 years for residential rental properties. This is treated as an expense on your tax return.
But the building isn't actually losing value, hopefully.
Right, that's the key. It's a non-cash expense. You aren't actually spending that money each year, but you still get to write it off against your rental income. This deduction can shield a large portion, sometimes all, of your actual cash flow from immediate income tax liability. It creates what some people call phantom income, cash in your pocket, that isn't taxed that year. This is fundamentally different from stocks, where generally every dividend you receive or capital gain you realize from a sale is immediately taxed. Depreciation is a huge long-term advantage for buy and hold investors. #headcheck outro.
Wow. This has been a true deep dive into the discipline, the reality of flipping houses. We've looked far beyond the staged glamour of TV, haven't we? Examining everything from that crucial required identity shift, forcing investors to value capital over consumption, to the practical mechanisms of using owner-occupied leverage, the massive risks that come with hard money loans and ARV appraisals, and even the granular detail of renovation cost estimation and styling a property to appeal to specific generational aesthetics. It is crystal clear this is a marathon, not a sprint, one that rewards systems, calculated risk taking, and just relentless endurance.
And if we connect all this back to the bigger picture, it becomes pretty transparent why real estate is such a favored asset class for long-term wealth building. Our tax and legal systems, for better or worse, are specifically structured to reward property owners who are educated enough and disciplined enough to actually seize the available advantages, particularly that ability to shield cash flow through depreciation that we just talked about and the power to defer capital gains taxes using 1031 exchanges. That ability to pull out tax-free equity through refinancing allows savvy investors to build wealth significantly faster than might be possible with other assets. But, as we stressed, seizing those advantages demands acute discipline in planning and execution. It doesn't just happen.
You mentioned when you first came to us a desire for quick knowledge, those aha moments. We learned today, quite clearly, that successful investors continually choose capital over consumption. They prioritize long-term gains over short-term impulse spending or lifestyle creep. That seems to be the fundamental difference between maybe doing one successful flip and actually building sustainable wealth over time. So here's a thought for you, the listener. What stands out in your own personal life right now that you are currently prioritizing as consumption, whether that's spending cash or maybe even how you spend your time or energy that could be consciously shifted into capital to accelerate your goals? And perhaps more importantly, what specific, actionable 12-week commitment are you willing to make right now to lock that decision in and start building that investor identity? That's your challenge from this deep dive.